You give me 8 minutes and I'll show you how to make better stock market returns than even some hedge fund managers. I'm Rahul Shah. I'm the CEO of DocShah Financial. We are a wealth management practice that buys stocks for clients and does retirement tax planning. I'm going to show you how to make the best risk-adjusted returns in the stock market. So let's jump right in. I'm going to use an example of a company called Teladoc. Now, they're a telehealth company. This is not to pick on Teladoc, okay? This is just for informational purposes. Now, what you're seeing on this graph here, and I'm going to look down at the screen so I can see this with you. You're looking at a black line that spans from 2014 to current day. And that black line is the stock price of Teladoc. And you can see that the stock price has gone up dramatically and it's come crashing down dramatically. And the reason why you watching this are probably not a good investor is because you base all of your investment decisions on this one black line. You solely look at the stock price and you decide to buy if the stock price is going up, and you decide to sell if the stock price is going down. That's what we in the biz call buying high and selling low. And it's the opposite of what you should be doing in investing. You should be buying low and selling high. But the question is, how do you actually do that? And I'm going to explain to you how to do that in this video. You see, if we go down to the little row that says EPS, and we look at negative 1.5 for 2015, negative 1.4 for 2016, and so on and so forth down the list, we can see that the EPS, or the earnings per share, right, the profit that the company makes, has been negative for every year that they've been in existence, is currently negative, and is projected to be negative for all of the foreseeable years that the company is going to be around. And so when we look at this, we have to ask the question, why are we buying a stock that has no earnings? And that's risk in investing. When you overpay for an asset, if you pay, if I go to the peak here at 2020, you can see the stock price was nearly $300 a share, and the company was losing $5.50 a share that year. And only 2 years later, they lost almost $85 a share. And so, it's no surprise that the stock price came crashing down. Investing is not astrology. If you buy companies that have no earnings, well, their stock price is only going to go one way, and that's down. Furthermore, if I show you this next tab and I go to the balance sheet for Teladoc, and again, this is not to pick on Teladoc, I'm just using them as an example. This applies to a lot of different companies out there. But if I go to the balance sheet, which is just a snapshot in time of a company's assets, liabilities, and then the difference between is their equity. It's just a point in time, how much do they have in assets, how much do they have in liabilities, and what's the equity. But the two most important lines on the balance sheet are, number one is cash in the asset section, and number two is long-term debt in the liability section. And so if we go here to Teladoc, we can see that in 2019 they had $517 million in cash. If I just scroll down, they had $440 million in debt. And if you see, if I just click this here and I put their debt on the chart, and then I add their cash on the chart, you can see here that from 2019 to 2021, right, that period where the stock price was just going ballistic and very elevated prices, not only did they not have any earnings, but they had more debt than cash. And so when you buy a business like that, which is all buying a stock is, you're buying a piece of a business, and you're buying into a business that is perpetually losing money, that has massive liabilities, debt that outweigh the actual cash, right, the potential to repay that debt. That's not a good investment, and that's taking on massive amounts of risk, and that's why your returns are not good. And so we have to ask the question, well, how do we reverse that? How do we go from this situation to a situation where we're actually making money and making good investment decisions? So let's use another example here. Now let's take a look at a company called Williams-Sonoma. This was a stock that we held in client accounts around 2023 to 2024. And I'm going to show you why this stock was placed in the accounts and why the results are dramatically different than, say, an individual investor holding Teladoc. So if we look at this chart now, the first thing you'll notice that stands out is that we have this large green shaded area, right? It wasn't there in Teladoc's case, right? We only saw that black line, which was the stock price. In this graph, we see that black line, but we also see the green shaded area, which is the company's earnings. That's why it was not on Teladoc's graph, because there were no earnings, right? They were negative every single year. In Williams-Sonoma case, you can see the EPS line, right? 89 cents a share. A few years later, 48 cents a share. We fast forward all the way to today, $8.79 a share. All you're seeing is the earnings plotted on this graph. And you can see here that the stock price essentially tracks the earnings flawlessly over a long period of time. With one little caveat, there are deviations from that, and we'll talk about that in just a second. But by and large, if you look at the stock price 20 years ago and the stock price today, and you look at the earnings 20 years ago and the earnings today, they have moved in tandem with each other. Peter Lynch famously said, "Stocks aren't lottery tickets. Behind every stock is a company. And if the company does well, the stock will do well. It's not that complicated." And it's one of the most true statements in investing. Stocks aren't lottery tickets. If you have a company like Williams-Sonoma, a great company that's producing more and more earnings every year, well, that stock price is very likely to simply follow that because stocks aren't lottery tickets. Now, if we look here, though, there are periods, right, in 2023 when we bought the stock across all client accounts that the stock price is significantly lower than the earnings. And this difference is called margin of safety. And as Warren Buffett said, those are the three most important words in investing. When we are buying stocks, we have to bake in a deep margin of safety. And a margin of safety is simply the difference between what a company is worth, the earnings that it's producing, and what a company is selling for, the price that you buy it. And if you buy a company that's worth a lot more for a very low price, that difference, that margin of safety, is what's going to help you sleep at night and what's going to protect your investments and help you make much better risk-adjusted returns in the long run. In other words, you're making a safer investment for a better return. Now, conversely, if you buy a stock for a high price relative to what it's worth, you're taking on massive amounts of risk. And you can see that even in Williams-Sonoma's case. If I go here, fast forward, by this time we had sold the stock because we felt it was overvalued. And at this point, the stock price is significantly higher than the earnings. And what happened? The stock price came crashing right down. So remember, stocks aren't lottery tickets, right? The difference, if you overpay for an asset relative to what it's worth, that's called risk. If you underpay for what an asset is worth, that's called margin of safety. Never forget that. That is the secret to making really good investments. Now, you might be wondering about the balance sheet, like I just showed you in Teladoc's case. In Williams-Sonoma's case, there is no debt and there's tons of cash on the balance sheet during that time period, right? 2021 to 2024. And when you buy companies like that are producing more earnings every single year, that have a net cash position, right? Tons of cash, no debt, and you're buying it for a cheaper price than what it's worth, that investment is likely to do very well in the long term. And so when you're thinking about your own portfolio and what to put in your accounts, don't think of buying stocks based on the stock price. The question you should ask is not, what's the price of this company? It's, what's this company worth? And once you ask that question and you answer it, then you can look at the price of the stock and determine if it's a good buy. So for example, if you've determined a company is worth $100 a share and you can buy it in the market for $50, that seems like a pretty great investment. If, on the other hand, you determine the stock price is worth $100 and it's selling for $150, that might not be a really good investment because you're overpaying and taking on more risk and you don't have that margin of safety baked in. So that's the secret to making better risk-adjusted returns in the stock market. If you don't want to have to worry about all of this and figuring out what the companies are worth and having to check the markets every day, and you just want your portfolio actively managed by someone who will do it in a prudent fashion, tailored to your risk tolerance and your goals and objectives in life, just shoot me an email, raul@DocShahFinancial.com. I'd love to hear from you and your personal situation and how I can help you. I make these portfolios every day for people from all walks of life, so don't be hesitant to reach out. I'd love to hear from you. And until then, I'll see you in the next video. Take care.